Welcome to the Balance Sheet, where you rise above the noise and learn about the most important business issues of our age. I'm your host and fellow student, Conrad Chua. When we think of startups, we think about hypergrowth, scaling, and when we think about the people behind that, we think the founders, the project managers, the tech teams who are driving that growth. But what about the finance side? We're so grateful today to have Akshay Sarma, CFO of Axio. Axio is one of the fastest growing consumer finance companies in India. Welcome, Akshay.
Hi, Conrad. Thank you for having me.
So, Akshay, can you tell us a bit about your career?
Sure. I started off with Deutsche Bank in London in 2007. Kind of started working with them on their trading floor. I was a trader's assistant there for about 2 years. Then I got the opportunity to kind of work on the structuring desk, where I was designing derivative products for Portugal, Italy, Greece, and Spain. After about a year and a half of that, I got the opportunity to move to Asia. And I kind of moved to a role where I was doing asset-backed financing in Southeast Asia and GSEC trading in India. This kind of, gave me exposure to different markets across the world. And after about a 7-year stint with Deutsche, I felt like I needed a new challenge. And my brother, who was in tech, kind of opened the door of what product world looks like, what building tech looks like, and I was very enamored by it. And I said, before I go in and actually take up a job and kind of hitch my wagon to a startup, I wanted to make sure I understood this world enough. And I kind of then applied for an MBA, and that's where Judge came in. Spent a year there at the business school, and then moved back to India to join what was then Capital Float and today is known as Axio. And I've been with them for the last 9 years, maneuvering macro events, some India specific, some global, as we look to build a great consumer franchise. And yeah, so here I am today.
Can you tell us a bit about how the JBS MBA helped you to go from this large financial institution like Deutsche into the startup environment?
Yeah, I think it played a very big role. I kind of got into 2 other business schools, but I very proactively chose Judge because of Silicon Fen and the access to startups. I spent the whole year working with a whole range of startups. I was fortunate enough to get on the board of Q as well. And that kind of really helped me understand. I worked with 3-4 different guys from business planning to commercializations. I think 2 things that Judge gave me. One was, I think, the understanding the importance of working with individuals. At the same time, respecting cultural differences that come out. I think that played a very big role. In fact, my first group of folks, which was Aaron, Lily, and Martin, played a very big role in me learning it, understanding that, and kind of, taking that lessons forward with me in life. And I think the second thing was that I loved fast-paced nature. I always knew that, but the entire MBA experience at Judge with rowing to doing a whole bunch of things around it at the business school, Q, the different committees that we were part of, I think it kind of re-emphasized how much I loved chaos and then kind of putting structure in chaos, if I may. So I think when I walked to the school, I was very, very convinced that startups would be an amazing place for me to kind of like move into post 7 years in an organization like Deutsche.
And for the people in the audience, Q stands for Cambridge University Entrepreneurship, I think. Yeah. And they organize activities across the university for people interested to start their own companies, or like yourself, Akshay, who are interested in the whole startup world. Right?
Yeah.
So to the audience, remember, you can put your questions in the chat or comments for Akshay. Akshay, can you tell us a bit about Axio?
Sure. So Axio was known as Capital Float when I joined them back in 2015. We started lending predominantly in the small business space. And post-COVID, we kind of pivoted completely into consumer lending. Today, we offer 2 main products. One, what we call checkout finance, but is popularly known in the world as BNPL. And we've integrated with merchants across the country, such as Amazon. We have a couple of other big marketplaces in India, which are India specific, such as Razorpay, Policy Bazaar, etc., that we've kind of tied on to give checkout finance to folks. And then after monitoring their performance, we cross-sell them a personal loan, depending on their performance on us, and obviously general credit history of these people. So this is largely what we do today. What I kind of joined them to build back in 2015 was actually a micro debt syndication platform. So the vision that, or the curiosity that I had back in 2014-15 was, how do you build a low leverage, large lending business on the back of, let's say these new age marketplaces that had come up back in 2013, 2014. So, the likes of Lending Club, Funding Circle, and P2P lending had become big. So I was very curious as to what India had to offer. But I always felt in India, you needed to be a regulated entity to do this. And as I was kind of hunting around, Capital Float, which was founded by Gaurav and Sashank, had just raised Series A. And they, funnily enough, had very similar views about what they wanted to build. So 2 phone calls later, I said, let's go and build this micro debt syndication platform. And the idea was very simple. The concept was, if a large conglomerate needs, €1 billion to go buy a plant or a bunch of plants, you have 5-6 large multinational banks that come together and give this entity a loan and diversify their risk. So the question was, if this can happen at scale, how can you use technology for the little guy? Can 2 institutions come together to give a $10,000 loan to a small business or an individual, which the traditional institutions would not be able to give on their own, right? Because the cost of doing business would have been very high for such a small ticket loan. So that was the question that we kind of started. And that's what we've kind of been building. And that's what I built initially, was basically designing the entire system, going out, talking to financial institutions to partner with them. And today, this platform's generated close to $2 billion in disbursements across both MSME or SMBs as well as individuals. And it's been a fun journey to kind of, not only being able to, find individuals and businesses to lend to, but also be a good channel or flow of capital in the country. So that's been a good journey. So yeah, in a nutshell, Axio does this.
Yeah. And a quick glossary check. So BNPL is buy now, pay later.
Buy now, pay later. Yes, that's right.
And MSMEs are micro, small, medium enterprises, right?
That's right. That's right.
So can you tell us a bit about what the market in India is like? The people that you're reaching out to. Is it are they very sophisticated consumers? Are there a lot of different financial services products that you have to compete against?
Yeah, because I think everyone wants to reach out to what everyone knows. India has a huge TAM. We have probably one of the largest young age population globally. So you have a lot of folks who are entering the work stream, for whom credit and what we in India call new to credit, right? So they're young people in their first job, and it's an untapped world for them in terms of access to credit that banks, NBFCs are all trying to get to. We have constantly believed that the new age or the young Indian consumer is going to be very digitally savvy, thanks to the entire mobile revolution we've seen in the country. So the ability to offer a product that can be easy from a consumer experience perspective, at the same time hold on to all the traditional values of risk management that a lending business needs to have, is potentially the way forward, right? That's the thesis that we've been building this organization on. So as a result, yes, we do have to compete with a lot of people. But, like I said, we're a country of about 140 crores, or 1.4 billion people. So that's a huge market for everyone to go. And like everyone else, you need the really, existing good credit customers while you try and find the new to credit customers and have a nice barbell strategy between the two of them to make sure that you have low risk lending with the traditional folks, as well as some amount of high risk lending on the new folks, as you teach what credit really means, what debt repayment means, and you kind of handhold them through that initial phase of learning. And you identify folks who get it. Some folks, unfortunately, don't. So you're able to, weed out folks who are not able to do this very well, and kind of continue to grow with the folks who are able to understand how to handle credit over time.
We were talking before the show started about how India went through a huge change in terms of the tech stack that enabled rapid growth of not just consumer finance, but loads of other digital products. Could you talk a bit about that big change that happened a few years ago?
Yeah, sure. I think there were two changes that happened. One was the government or the central governments across two governments kind of came up with what is known as Aadhaar, which is a unique identification for people in India. This allowed almost the ability for an individual through his phone to digitally verify who he is and his credentials, right? So this was an absolute game changer with respect to covering basic KYC. The ability for an individual through his phone to let any FII, whether you're lending or you're into the stock market, but actually know this is me by clicking a couple of buttons is super powerful. And then the government built what is known as UPI in India, which is like a payment rails that is leveraged by almost everyone in the country for P2P money transfers. And I think a combination of these two kind of has allowed the country's consumer transaction landscape to change massively, right? We've largely moved into a digital economy from a consumer spending perspective, including P2P transfers between individuals. People use UPI frequently. The regulator is just launching credit on UPI. So there's innovation on this entire stack that is continuing. It's not just stopping with these two. Just like you have a United Payments interface, the regulator recently is launching a lending interface as well, which can kind of help folks to come and give folks credit through this platform. So I think the ability to kind of, digitize the nation through mobiles and have a common tech stack that's connecting the entire financial services, plus a centrally recognized authentication machine, if I can say that, has kind of allowed the entire landscape to kind of change, right? And the folks behind this deserve a lot of credit for what they've been building over a long period of time. So everyone sees the explosion that's happening today, but I'm fairly convinced a lot of work would have happened years before anyone saw this. It's been pretty phenomenal from that aspect.
Yeah, and it's been very impressive to see how India has really leapfrogged a lot of more established countries with this, right? Where in the UK there's no Aadhaar kind, so you always have to go through huge hoops to satisfy a bank's KYC, which is know your customer. And I have a feeling that a lot of, from my own personal experience, running the student club, which I think Akshay you helped to run as well when you were here, is that a lot of times banks just decide not to bank with you because they can't get one piece of information. But I think in India has figured out that to do this in a way that's grants incredible access and quite equitably as well, isn't it?
Yeah, I think that's actually really pretty accurate because when you have the population that we do, it's impossible to physically get to every single person. But with the advent of the mobile and data, that has played a very big role with the number of providers in India. Like you have the Airtels, the Vodafones, the Jios that have made sure data is available to almost every nook and corner of the country. And with cheap smartphones as they are today, I think people realize very quickly this phone is now the way to give people access to everything they need. So it was very important to build a layer of security, a layer of identification on the back of this, right? And I think they've managed to really managed to do that really well. And that's, people like us can come and build a business on top of it, and we can reap the dividends of something that's been done for the benefit of the nation. But yeah, it's a fascinating piece. I think you can do a whole show on just the tech that's been done with the folks who've built it separately, because the thinking and the execution of this was something else.
You mentioned, Akshay, that when you joined Capital Float in the mid-2010s, it was very much focused on that kind of micro, small, medium enterprise lending. And then now with Axio, it's very much consumer finance. Can you give us a sense of what was the company like when you joined in terms of the number of people, the number of products, and how has that grown to now?
Yeah, I mean, I think in the early days, it was, I was, I think, employee number 168 back then, but I was the second guy they had hired on the liability side. Everyone they had hired were tech, product, sales, or risk guys. We were lending out of equity. We were doing a 15-day loan product. We were waiting to kind of launch slightly longer tenure products. So I kind of built, while I was building out this syndication platform, I also built their entire liabilities grounds up, right? So the first borrowing the company did was something that I put in place. The first institution loan I had kind of helped put together. So it was very young. I think the AUM or the asset under management of this company was, I don't know, 3 million, $4 million back then. It's really small. And since then, we grew to a roughly 200 crore, $200 million asset under management. And then the country went through a bunch of macroeconomic events that were very specific to India, which kind of ended with COVID, right? And I think during this phase, we ended up launching, or the early part of the journey when we were focusing on the small businesses, we had almost 10, 12 products catering to different kind of small businesses, different repayment schedules, depending on the kind of cash flows businesses had. So we're very, very focused on trying to design loan products around cash flows that businesses were generating, right? Because that would allow timely repayments without having to worry about a bunch of other things for them. I think as COVID kind of hit, and in India, particularly the second wave kind of hit us very hard, we kind of realized that, hey, and sorry, let me backtrack a bit. In 2017, we also launched the consumer side of the business, right? So at one point in time, we had both the MSME business running and the consumer business running because we felt we needed, they're a natural hedge in India. Both verticals don't kind of see cycles together. So it was important that we ran both of them. But post-COVID, we kind of said we're going to pick the consumer side because we don't know what the world will look like post-COVID in India. Because MSMEs are largely offline. The COVID world was, forcing lockdowns to happen at fairly high frequency. On the other hand, there was a sudden surge in digital adoption of consumer products in the country. And our consumer product really took off. We were seeing tremendous growth, great repayments. So we said, okay, let's focus on this and let's build this because we're seeing a behavioral shift in how people are willing to take credit, use credit, and repay credit, right? And so that's when that journey began. And today we are, I think sitting close to about $300 million in AUM because we went from $200 million to, I think, a little less than 100 million, had to rebuild all of this on largely short tenure lending, which doesn't really help grow your balance sheet. But we, put in the hard yards and said, no, it's going to take time, but we got to do it the right way. And we kind of built it all back up again. So today, like I said earlier, we offer checkout finance and are constantly looking for larger merchants to kind of partner with and offer folks credit at checkout and then cross-sell, personal loans to them depending on their need. And that allows us to pick the customers we like to offer loans to. And the idea and the thesis is that the credit risk will be lower because I'm seeing folks and I've built a relationship with them from before. And I'm now giving them two kind of products and not just one. So you're kind of building a relationship with folks as they kind of move in their life as well.
So, Akshay, can you tell us a bit about what you do as CFO at Axio?
Yeah, sure. Look, I think in the world of lending, a big part of the role is liability management and making sure you are running an institution that isn't overly leveraged and is managing its cash flows really well. Because the world of lending is, you can really simplify it down to I'm borrowing money from a bunch of institutions and I'm lending money to a bunch of people. I always need to make sure that there's no mismatch in cash flows. So if I have to repay my lenders $100 in a particular month, but I'm only getting $50 from my borrowers, then I suddenly have a $50 mismatch that I need to kind of put in from my kitty. So it's in a very simplified manner, managing cash flows of the entire business is very important. That's part one. Part two is where are you getting your source of funds from? So are you kind of getting it from banks? Are you getting it from foreign institutions? Like I mentioned, the debt syndication platform was a very important tool of our liability because folks are lending directly to consumers, not to my balance sheet, but I'm still building assets, under my name and under my control, which is always the good thing from that perspective. So that kind of helps. Managing liabilities, managing the range of liabilities, managing cash flows, and you have the general accounting and financial controllership that comes with any CFO role, anyway, right? So these three are probably at a high level stuff that kind of come under my control. Now, because cash flow management also entails knowing whom you're lending to, how the repayments are coming, how the collection systems are working to make sure the money that's coming in is correct. You kind of have to have your hands in almost all the pies and make sure all the verticals are doing what they are. So I actually have a very cross-functional role where I have to work with the business folks to make sure the business teams are pricing, doing things the way we want them to from a P&L standpoint. We're building the right risk metrics for the business. The collection stack is working pretty well across the board. So it's a very, like I said, cross-functional, very team-driven role where you have to work with different set of peoples to make sure that things and the company is moving in the direction that you want it to. And if there are any potential mishaps, then you're able to fix it very quickly, right? So one key aspect of this is FP&A, right, which is your entire financial planning and analysis. So I constantly have at least 4 versions of what this business will look like over the next 6 months. And depending on events that I'm predicting, based on my understanding, I kind of look and follow a particular train and be like, hey, this is what it's going to look like mostly. And then I go have conversations with everyone and be like, hey, I think we need to tweak this to bring it back on track. Or, what, everything's going great. You guys just keep doing what you're doing. And this is working out really well. So, it's a combination of easy conversations, hard conversations, but at the same time, constantly building contingency plans for the business, because God forbid something goes wrong, you need to make sure that you're there to kind of catch the ball before it falls on the floor, and you're building enough safety nets to make sure the business is safe, right? So it's a lot of, in a startup, it means a very, very deep partnership with the founders, the ability to speak your mind very freely, for them to respect your point of view and understand why you're coming from a particular perspective, right? And I think that kind of, like I told you in the beginning, the relationship building is very, very important, because not only do you have to have the founders trust you in a startup, but so should your colleagues, right? They should know that you are not approaching a solution with some sort of a hidden agenda, but you are thinking company first, right? The idea isn't for Akshay, the CFO, to be right. The idea is for Axio to be right, right? So if I have a view that is challenged with somebody where I've realized that that is a better solution for the company, we need to implement that. Not because the CFO of the company is saying something. I mean, titles are irrelevant in startups. It's about making sure the organization is moving in the right direction, and it takes an entire team to make that happen.
That's a fascinating kind of overview, Akshay. And when you talk about working with the founders obviously are still running CEOs, leading Axio. Yep. And it just got me thinking about this discussion topic that seems to have taken Silicon Valley by storm in the last 2 weeks. For those who don't know what I'm talking about, Paul Graham, one of the founders of Y Combinator, posted a blog post, and he talked about this thing called what he calls founder mode, right? Basically, he says this advice that CEOs, founders should hire good people and give them room to do their jobs is misplaced, and it's bad for the company. Instead, he says founders should push back on autonomy and get a lot more involved in the details of some of these projects or decisions. So Akshay, have you found working with the founders of Axio to be a very different experience, right? From working in this larger company like Deutsche, but where do you stand on this founder versus manager mode?
It is very different from Deutsche Bank. Because I think in a startup you get more ownership. In a startup, Akshay, the individual, can actually make a very, very serious contribution. In Deutsche Bank, for Akshay, the individual, to make a contribution, I have to spend a really long time, climb up the ladder, and then I can make an impact. But in startups, you get to make that impact very early on, right? So yes, there's a very big. It's one of the reasons why I wanted to move into a startup. I wanted a higher degree of ownership. I wanted a higher degree of freedom to operate, execute, fail, rebuild, and then succeed as well, right? So you want that, which is why you want to go to startup. Look, I don't know about founder mode and manager mode. I can tell you this much though, and this is how I've always looked at working in a startup. When you decide to join a startup, you are joining somebody's vision or dream because you align with those goals, but it is those individuals' vision or dream. So you are aligning to build a company with people who had the idea, took the risk, and put in whatever hard yards it was to set it up whenever you join them, right? So number one, never ever forget that. As much as you spend people spend a lot of time, and you could consider yourself as in line with the founders because you know as much and you've done as much. You've not. The founders are always going to be the founders, and there should be just no two ways about that at any point of time, because they spent and thought about this in a lot more different ways than you've had to. And you as an employee always had a salary no matter how bad things were, right? And the founders on the other hand take a lot of the emotional roller coaster, I think, that founders go through. Early stage employees might feel they go through that, or may probably go through it as well, but there is a distinction. So for me, founders have no boundaries. They will step in when they need to. They will step out when they're comfortable. So the onus is on you to make the founders go into the manager mode, and be absolutely okay with it if they decide to go into the founder mode and do an absolute deep dive, because they're doing it for a reason. Something's bothering them. They don't like something. They are not understanding something. So you can at no point stand up and say, don't worry about it. I got this. Trust me. You'd love to be able to do that. But you also have to realize that they have the most to lose if things go south. So they will step in and they will step out, which is why I think one of the biggest misplaced conceptions in the world of startups is that you can jump jobs in startups and still kind of grow in responsibility and get people to their manager mode. It doesn't work that way. You have to earn trust. You have to earn the founders' trust, their ability to actually say, you know what, I have a problem and this guy's the guy to solve it. And I'm going to brainstorm with this guy to solve this problem, right? So in my head, there is no founder mode and there is no manager mode. There's only the founder mode. And when they get comfortable to you, they will become the manager. If they aren't, that means that bridge and that journey both of you should take hasn't been completed yet. And this also, by the way, comes down with having very honest conversations with them about wanting the liberty, about wanting the freedom. Certain roles, like my role, by design, will always step on the toes of founders, what they want to do at times. So this role requires me to walk up and say, nope, not right now. Here's the reason why not. And then they'll come back and saying, we understand, but we still need to do it because of ABCD reasons. You have a conversation, you agree, you disagree, but if you disagree, you commit to the solution and you move forward. So it's very, very important to then sit back with them at some point in time, go grab a drink, go grab a coffee and say, listen, I've been starting to feel like I'm not getting the freedom. I would like some freedom. Can we start maybe trusting me a little bit more? Can we start? What do I need to do? What have you not liked? Have those hard conversations, because look, they're human beings too. They're also figuring out how to kind of do a bunch of things while they have a very strong gut feel on how things happen. You come with a domain expertise. You don't come with maybe the breadth of views that they come with. So you have to learn how to do that. I've learned that here. I came with a very single mindset about what lending could be like. But as I work with a bunch of folks and with them, you kind of broaden your horizon a lot more. And then you're like, hey, actually, there's this other angle, and this is why this decision's kind of hard for you to make. So yeah, that's where I am on this. I think it's a two-way street, and it's not completely dependent on founders. I think it's unfair to put so much on founders and say, you should go onto the manager mode, but what about you? What have you done to give the founders the comfort that, yeah, manager mode is the mode for him? Or so if you're finding yourself in a position where it's founder mode a lot, like I would ask myself a lot of questions about, what have I not done that is forcing them to be founder mode and not kind of make the switch to the manager mode, right? And of course, you will have folks who are just micromanagers by nature, but you need to go in and have that chat with them, right? You should be comfortable to give that feedback as well, right? And if you feel that then it's not going in the direction, then that's an easy decision for you to make whether you want to continue or not. But walking away without having these chats, I think, is almost criminal, because neither are you helping them grow, just like you want them to help you grow. But what are you doing for them? Because at the end of the day, we're all people trying to build something together. So there, as the potential for them to be wrong is as much, maybe slightly less, maybe slightly more as you. So why not engage? Why not engage? Why not have the conversations? And the end of the day, the idea is together to build something awesome. It's never going to be one person, right? Even the founders, they're the face of it. They will take the credit and the blame when things go wrong, but they also appreciate the fact that the team behind them is rallying when it's needed and is building when it's needed. So everyone understands it. So it's all about just sitting down and having these conversations, I think.
So for those who are watching this on YouTube, you can click on the QR code later on and it will go to Peter Graham's blog post on founder mode. Actually, we have a question from the audience. Sarah Jitkrason from Thailand asks, Akshay, it appears your role is heavily involved with finance operations, FP&A. How can a CFO engage more in strategic business areas in a startup? Should the CFO also participate in driving growth through organic or inorganic means?
100%. In fact, the ability to do FP&A without any strategic insights on the business is almost pointless. So the idea isn't for you to sit down with an Excel sheet and just be like, sure, give me your numbers and I'll tell you what the Excel is doing. It's also for you to have an intuition about the business to understand, is this the right thing? Does this make sense? So in startups, especially, I think CFOs it's very important for you to understand why the startup is hiring a CFO and not a VP finance. So if any startup is offering someone the role of CFO, the first question I've asked when I've gotten offers is, why do you want a CFO? Why do you not want a VP finance? And in my view, the only answer is because they're like, hey, we need someone with a bit more strategic insight from the finance side to solve our problems. And if you're not getting that answer, you should never take up the role of a CFO, because then they need a controller, they need an accountant, they need someone to make sure the books are clean. That's the role. So it's very, very important for you to understand what is it that you want, what is it that they want, and make sure it's aligned. So without any strategic insights, you're not going to go anywhere as a CFO. Two, if a business does not grow, again, what are you doing there? Grow the CFO. So, in finance, there's this very traditional definition that a lot of folks use, which is, finance is like the brakes of a car, and, the better the brakes, sometimes, you're faster you're able to drive. I actually have a problem with that definition in my head at a lot of levels, because I'm just like, you're making finance a very restrictive function by design. You're not making it a part of your growth. You're not making it a part of your future plans, but you're using it as a controller. And that's one of the reasons why, even though I'm not an accountant, the role in a lending business makes sense, because I'm at the center of a lot of things. I'm at the center of money supply. And for me, finance in a lending business is like the beating heart. I need to make sure blood is going to all parts of the body and there are no blockages, and every part of the body is functioning the way it should be. So if you are able to draw this distinction between these two statements about being a brake vis-a-vis being a beating heart, automatically, I think you've now separated operations from strategic insight. Because without strategic insights of knowing how much blood to pump into some part of a business and why it's needed at that point of time, you're never being able to come up with solutions that is needed for the organization to thrive. So 100% the role, whether it is organic, whether it is inorganic, the ability to walk up and say, I have an idea and I think I need to solve this in ABCD reasons, is the job. Everything else you do is always going to be operational. Look, any job in the world, including CEOs and top salespeople, is at least 80 to 90% operational work. Strategic thinking is 10 to 20%, and you don't build strategic thinking if you don't have operational insights. Because one of my favorite lines from my time at Judge was the strategy class, where they said, I'll never forget this, but it said that every organization has three strategies: one that's devised, one that's communicated, and one that's executed. And the reason why you end up having this in organizations is because the person devising it has never executed it. The person communicating it hasn't never devised it, nor has executed it. But if you are an individual who's built and has made your way up the ladder in the same company, when you are now devising any strategic initiative or an idea, you actually know what the operational hurdles to that execution is, so you can come up with better strategies. So it's very, very important for you to spend time in companies or understand the nuts and bolts of a company. So without operational understanding slash excellence, just for the lack of a better word, you will never be able to give any strategic insight. So don't underestimate the early part or the grunt part of a role, because without that grunt, your understanding of the business is nothing. So please make sure that you don't get awed by the word strategy in a role. It means nothing if you have no idea how the company runs and what on ground realities of execution really are. So execute, be an operator. Strategy will come so naturally you won't even know when you made that switch.
Following on, what you mentioned, how as a CFO, as someone in finance, and you get approached from startups who want to recruit a CFO. If I flip it around, what is your thoughts about when does a startup need a CFO and no longer just a VP finance or a controller?
I mean, look, I think it's a hard question for me to answer, but I will answer it from a perspective of if I was running my own startup, because then as a founder, I am looking for something that I do not have or I do not have the bandwidth to do, right? And for me, that is, I need someone to take care of not only the finances of my business, but someone to think about the long-term consequences of choices that I'm making today, right? And from a financial angle, from a risk mitigation angle. And I think the moment as a founder, I feel I don't have the bandwidth to that. That's when I'll say, you know what? I don't want someone just to publish the monthly books of accounts to my investors. I need someone to think about this day and night, right? So that's what I would do. And I think in general, that's what I look for as a design, because I'm like, if you are not ready for someone to be a strategic partner to your decision making, this role can actually be very frustrating, because to the question earlier, it'll be a lot of operations and none of the strategy, and you're kind of pointing out the consequences of the strategy being there with very little insights of what to change or why that strategy is being taken. So I think it's very important to kind of build that nuance out.
We've got another question from Sarah in Thailand. Sarah asks, with the advancements in tech and consumer transactions in India, are there still significant challenges in reaching lower income customers and businesses that are less digital savvy, more offline oriented? What specific solutions have you found effective in integrating online and offline landscapes of financial services?
Look, I think in India today, even if you're a lower income customer, you have a smartphone. And if you have a smartphone, you're digitally savvy and you're hooked. So you're good enough for me. So the benchmark that I have is, are you someone with a digital footprint? That means, have you made transactions digitally before? Have you made a purchase digitally? I can assure you, it is a very small percentage of the country today that hasn't done it. They might not have credit products, but they definitely have their bank accounts that they're using across the board to kind of make it happen. At least in, maybe it's wrong to say a small percentage, but I think in the metro, tier 1, tier 2 cities, which is a big part of the country, it is fairly popular. I think digital payments have kind of even made its way down to rural. Access to credit is a different question, because you need to have the ability to kind of collect from these people should they default. So you are kind of restricted by your ability to reach them. And it might need a physical visit at that point of time to kind of go meet, understand what's going on. So you kind of restrict your growth or your potential reach on the back of how far your organization reaches, for lack of a better word. Look, on the business side, in India, it remains a phygital, what we call phygital. It's physical with some amount of digital elements of it. So there's a lot of data that kind of comes through in digital channels, but you still need to go about physically and carry out a bunch of activities as well, right? So in our earlier world, when we were doing small business lending, we had that. We had people that would go and do what was needed from a physical perspective, and we try and automate as much of the tech process of the underwriting or the loan application process that would kind of help us. So the idea always is, it's always going to be a bit of mix and match eventually, right? And the one aspect that will remain physical is collections, right? If you need to collect money from people, you need to be able to go reach them, talk to them, and figure out what's working, what's not working. How do you make sure or understand if the customer has any ability to repay you? And when you're doing unsecured lending like we do, it's very important for you to get to the customer first before, and if God forbid he has more loans, then his obligation to repay is across multiple lenders. So you want to make sure you're getting in there first, understanding and kind of doing what's right for him as well as what's right for you. So that will remain physical in a country like India, and that is something that we've built. We've built tech that allows my collection team to reach people faster, to kind of communicate with them faster, commit to a particular repayment plan faster, but they still need to get there. And it's a good example of trying being physical, but at the same time using tech to kind of make their life as well as the customer's life easier.
One final question for you, Akshay, which is, what's your advice, or one piece of it, most important piece of advice that you would give to business school graduates who want to work in a fast-growing company in India like Axio?
I think the biggest piece of advice I can give is, please check the ego sense of entitlement that you might have because you've gone to a school like Judge at the door, and walk in ready to get your hands dirty and rolling up your sleeves. In larger organizations, when you come from a business school, a particular business school or a brand of a business school, it opens doors for you. You meet alumni, you do a bunch of things, and you can network your way in the corporate. In a startup, it's all about execution. And if you are someone who wants to work in a startup, congratulations on completing your MBA from CJBS. Forget about it. Go get your hands dirty. Start from zero and build. And constantly ask questions to learn, because if you're not learning in the early days of a startup, you're doing a lot of things wrong. Because that lack of learning will come to hurt you as you kind of grow within the organization, or you want to grow and you're not able to. So I think the ability to ask the right questions, keep learning, getting your hands dirty is super important. And forget which business school you came from. It is immaterial in a startup. It opens the door for you. You get an interview, but after that, it's everything that you've learned from the business school that will actually help you. So all the lessons on cultural integrations, all the lessons on teamwork, on collaboration, which was huge at Judge. Those are the things you want to hold on to, because that's what's going to help you make you really successful.
Thank you so much, Akshay, for that wonderful tour through your career and understanding how finance can help power that growth in startups. So, thank you to the viewers for your questions as well. The balance sheet will be back 1 week from today, 20th September, 12:45 to 1:30 UK time. We'll have another MBA alum, Wan Hong, who will talk about social enterprises and international organizations. Till then, stay well and see you next time.